make sure I record it this time, is because there's so much about 1031 exchanges that most people don't know. And I guarantee you in the second hour, you're going to say a couple of times, I didn't know you could do that. I didn't know you could do that. And so what's cool about it, we all work with investors and buyers, right? And we have friends, family that have rental units. And when they talk about selling it, strategy up front is super important. Knowing what you're going to do before you get into it. Like I just had a client sell a property. You might remember me emailing you, and he said, hey, he bought a property. And then he emailed me and he said, hey, can I do a reverse 1031 exchange? I got one of my other rentals I want to sell. And it's like, he's already closed on it. It's already done. It wasn't set up properly. And so the answer was a big no. So knowing what you want to accomplish, Ray is really great at taking your clients, taking your people that want to do something and move one investment to another and explore their options. So pay attention today, take some notes. You're not going to be able to explain it the same way, but you will have Ray that you can hook up your people with so that they can talk about their unique situation. So I'm going to go ahead and share the screen real quick, and then I'm going to pull Ray in and let him do any other introduction that he wants, and we'll get rolling. I think it worked.
I think it did.
I think it worked. So click here.
Go back. Oh, well.
No. Give me 1 second, guys. Oh, back. Let's just make sure the clicker's working for Ray.
There we go. Okay.
Okay, we're working.
Okay.
Forward and reverse. Ray Beck, everybody.
Thank you. It's good to be with you. We've had a good relationship with Jeff. I'm thinking, how many years have we been doing business?
We're going on 20.
Yeah, I was gonna say it's that, and we've been doing exchanges since the mid 1990s, and so it's been a kind of a fun career in that. There's a bunch we're trying to do here, and let me do the paperwork out of the way first. For those who are here and participating in person, in the packet of documents you have there, you'll see a registration form. Fill in the blanks. I need to have you fill that out and give your license number and so forth in order to get you credit. Okay. For those of you who are watching online, the state has issued new guidelines with online presentations and that. So we have to do a couple of things. One, we have to verify that you're there periodically throughout the presentation. You'll see what that is there for. We have a little kind of funny little code words and that kind of stuff to deal with. But in order to do it, but the first thing that you need to do is, let's see if I can get this clicker to work. And if not, you need to send an email right now, if you can, to this email address, registration@summitexchangeservices.com, giving your name, address, and contact information. In other words, your email and also your license number. If I don't have that, I can't verify to the state that you're here, and I can't give you credit. So again, very simple. Just email registration@summitexchangeservices.com and just give your name, contact information again, email and so forth, and then also your license number. That's the way we can verify you're there. While you're doing that, I'm going to talk about a couple of other things as we go along. We're going to talk about a lot of things. You only have 2 hours. It's very easy for me to get talking too fast and just to try to do too much. It's also very easy to say, oh my goodness, this is boring tax stuff, and it is. But at the same point in time, I want to consolidate this down to the point of, yes, we're going to go through a bunch of principles, but I've also sought just short one-line principles. If you focus on not all the discussion, but on just a couple of principles, you'll see, and you'll see these little phrases as you go along, that will get you 90% of the way there. The goal of this class is to educate you about 1031, but really more importantly and more realistically, to have it so that you can just recognize 1031 opportunities. You don't need to know all the different rules. That's what we do. But you do need to be able to recognize when a 1031 exists and when it's not, and be able to advise your clients so that you can be a real asset to them. I will say it now, I'll say it several times. Savvy real estate investors understand 1031. They expect their real estate people or professionals to also understand it. And if you do, one, you can always add real value to what you're doing. Two, there's two sales. There's always a sell and a buy. And by coming, and they have 45 days, we'll find out in a minute. They have 45 days to identify potential replacement properties. That's where you can get the real service. I've got to find a property. Who can help me do that? And that's where you can step in and really be the white knight in doing it. And you can add value to that. So 1031 is just really, I think, is nuts and bolts of what we're doing. The second, the last point I want to say is this. I'm going to talk not as if you're real estate professionals, but as if you're real estate investors. I haven't found too many real estate professionals who just say, I just want to earn commissions. I don't want to really collect rents or those kind of wonderful things. And so, because I'll put you in that mindset. And if once you understand the mindset of an investor, you'll understand why 1031 is there. It has really become a currency amongst real estate, and it allows people who are real estate investors, they just use it as 1031. I mean, how many rollovers has Jeff done? I don't know. I mean, if you're investments, but as a strategy, we're going to show you that strategy in just a second. So again, don't get too lost in the forest here. There are just a couple of principles with simple sentences. If you get those principles, you'll have it. Two, like I say, think as an investor would think. We'll talk a little bit more about that. And three, like I say, understand that you are adding value. You are earning that commission by being able to advise your clients as to what they can do. It's an amazing thing. So once again, I just want to remind, if you're watching online, please send your name, email contact, and your license number to registration@summitexchangeservices.com. Please do it now, so that's the way we can tell the state, because they request us to monitor these things that you're here. Okay.
Didn't show up an hour late, you mean?
Didn't show up an hour late, and like I say.
That's why it's not in the chat. If anybody needs that email address repeated, chime up now.
It's right there on the screen. Yeah.
Oh, okay.
We'll also notice if we see a ceiling fan spinning around here for the next hour or two, we'll question whether you're there. But anyway. Okay, here we go. First off, like I say, let's have some fun. Let's think about this. I mean, I'm a tax attorney. Do you know the definition of a tax attorney? Tax attorney is somebody who's pretty good with numbers, but didn't have enough personality to be an accountant. So we need to have this liven this up a bit. Okay, here we go. Let's talk about some tax basics, some things we're going to talk about throughout the thing. And
How come it works when I touch it, Ray?
I don't know. Let's see. There we go. Here we go. Some very tax basics. We're going to go quickly here. I realize this is exciting stuff. Tax basis. Tax basis is the amount of money you put into a property. It is what you have previously paid tax on. So you don't want to pay tax on it again. What happens then is, okay, fine. You invest in a property. This one's going to be $100,000. You have $100,000 worth of basis. Assuming that thing appreciates, you'll then have the $200,000. You'll have now a taxable gain. The amount received, the $200,000 less your basis, constitutes the taxable gain. That's what we're going to be talking about today. Now, the capital gain rates can be fairly significant. If it's low, if you're in the lower tax brackets, it's 0%. But if it's up to $496,000, 15%. And over $496,000, 20%. Note, however, that the sales price of what you sell is included in those numbers. So if you make X for just your regular job, your client does, you put on top of that the sales price of your property. So it's pretty easy to get to the 15%. In fact, this is rare to get into 80%, the 0%, 15%, fairly easy, and quite frankly, fairly easy to get to the 20%. Plus, you have 4.9% state tax. That means that you're looking at somewhere between a 20 to 25% tax rate in order to do it. If you have, I'll have questions, give me a second. If you have depreciable property, in other words, had apartments or something like that, you've depreciated over time, you have to recapture that depreciation. That tax rate's 25% federal, plus your state. So in those circumstances, you're looking at a 30% tax rate. You may have also Obamacare for 3.8%. So my point is that you're looking at a 25 to upwards of possibly a 33% tax rate here in the state of Utah. If you're in California, it's 20% plus 13.3% plus, you can get to 40% very quickly. We have a question.
Wow. Okay, so if you're just under the 20%, the sale of that property can bump you up into that 20%.
Exactly.
It counts towards your overall.
You take your W-2 income. The question was, is that included with your W-2 income? The answer is yes. So if you are making, I say $450,000 a year, I'm not saying you are, but then you sell something for $100,000, you're at $550,000. So you're in the 20% tax bracket. Very good. And like I say, I want to make this be a conversation. So hopefully we can have through the chat or through the people here, we can have answer those kind of questions. Those are the basic principles though. The point being is the amount received less your basis equals your capital gain, and therefore the tax rates go on to that. Now, let's do very easily, carefully here, an example, which I'm going to talk about throughout, about here's what savvy real estate investors understand between doing a 1031 exchange and not doing one. We're going to do a couple of assumptions here. They may not be too realistic, but they're easy math, and that's why we do them, but they also do show the principles. We're going to say you're going to start out our investing career and you're going to go take $100,000, which we've earned somewhere or somehow or ever received it. We have that. It's already been previously taxed. You're going to put $100,000 in and buy a duplex. There's no reinvestment because this is our first property. And we're going to make an assumption with all of our investments that they're going to double in value. So with time, this property becomes from a $100,000 property comes to $200,000. We've learned before that the gain on that would be the 200 less the original 100 investment. So that becomes a $100,000 gain. We're going to assume, again, for easy numbers, that we're in the 25% tax bracket. That's 20% capital gains, 5% state, 25%. So on that sale, we're going to sell and we're going to have a $100,000 gain times 25% means that we're going to have a $25,000 tax. Okay, that means we have net $175,000 from that investment. That's a great outcome. We doubled our money. We've made a bunch of money. We've had to pay some tax. Not the worst thing in the world. Now, here's my quiz for those who are close by. How many here would like to get an interest-free loan from the government? Interest-free. It's amazing. It took you so long to think that. How many would like to get it so that you don't have to pay that back and that loan back until you want to? How many want to get it so that you don't have to pay back that loan at all?
Hell yeah.
That's what a 1031 does. Savvy real estate investors know that, and that's why they do 1031 exchanges. Let me demonstrate. Let's compare now with a tax deferred exchange on the exact same thing. $100,000 investment bumps up to $200,000. We have a $100,000 gain, but now we pay no tax, 0%, because we're deferred it. That means we just kept $25,000 in our pocket. That is your interest-free loan from the government. You don't have to pay that back until you want to, and if you want to. But that's the loan we're talking about. So now we come back and say, okay, fine. After we've gone through that transaction, rather than having $175,000, we have $200,000 to go reinvest. That's the $175 previously, plus the interest-free loan, the $25,000. Okay, we go through our investment life. We're going to take that same comparison, go into our next fourplex. Okay, we take the $175,000, which we got in a taxable situation, we buy the fourplex. We take the same $200,000 in the non or tax deferred situation and buy that a nicer duplex for again, $200,000. Note here what happens in the taxable conversion. We invested $175, again, it doubles in value. I don't know how quickly, but it will double in value at some point. We have a $175,000 gain. Lo and behold, we still have the same 25% tax rate. We now are going to write a check for $43,750, send that off to our good old Uncle Sam. We now have $306,000 left over. Again, not a bad deal, made a lot of money, but compared to our tax deferred, we invested $100,000 with $200,000 there in red. It doubles in value. So now it doubles to $400,000. We have a $200,000 gain. But this time, rather than paying $43,750, we're going to keep that money because we've done an exchange, zero. So now we have $400,000. Our interest-free loan from the government just increased by about $60,000. We have it. Note here, all we're doing, like any leverage situation, we just have more money to invest, therefore more money to appreciate, but there's no interest on this. Let's continue the example. We take the same thing, go in and say, okay, we're going to buy a 3-plex, a 8-plex. We take $306,000 in the taxable situation, but now we have $400,000 in non-taxable. Again, the same things happen. It doubles in value. We don't pay the tax. If you do the taxable, you pay $76,000 in tax. You haven't paid anything if you do the exchange. Keeps going. We take that 8, that same, go into a 16-plex. Ultimately, we get into a 32-plex. So let's go over our investment career. Maybe this is a 40-year period. I don't know, but we just those are the assumptions. Note here the differences right now. In the taxable situation, we've only been able to reinvest $937,000 in change. In the non-tax, or in the tax deferred situation, we have $1.6 million to invest. Think about it also, it's not just the appreciation. If we get a 5, 6, 7, 8 cap on that money, we have that much more invested, again, interest-free, that is now generating a higher rate of return on the interest, on the appreciation. We win on all accounts, and you can see there at the bottom the different increases. So you say, okay, fine. At the end of our investment life now, with 1031, we bought something for $1.6 million, and now we're $3.2 million. You say, okay, that's great, Ray. That's a wonderful story. But ultimately, aren't we just kicking the proverbial can down the road? And the answer is yes. But while that can is being kicked, you're doing it with interest-free money and making a heck of a lot more. Here's the comparison. If you, after the end of this whole thing, the taxable party paid $513,000 worth of tax over the period of his lifetime, of his investment lifetime. Now, the non-taxable, and here's where it comes in, it says, because you don't get to increase your basis, those previously taxed dollars, your basis in that 32-plex is still the $100,000 we talked about. And what's our formula? You take the amount received, remember it doubled in value, so it's $3.2 million now, less our basis, so our taxable gain is $3.1 million. You're saying, oh my heck, Ray, that's a huge, now you have to pay the piper, what's happened? And you're right, there's that gain and there's a $775,000 tax that has to be paid at that time. But so what? Note the difference here. The net value of this investment scheme for the taxable is $1,641,000. Even after paying the additional tax, and I'm smart enough to know that 513 is less than 775. Note here, my net worth in those investments is $2.5 million. Why? Because I've had this interest-free loan working for me over the time. It's increased my appreciation. It's increased my annual income just on rentals or whatever, however you're generating it. All those things add up. If you look at the numbers there, percentage increase, 70% annual appreciation, you have 101%. You're basically doubling your money. Again, there's some assumptions. I understand. Everything doubles in value. We do it this quickly and all those kind of things. But this is the principle. This is what savvy real estate investors understand. Now, you said, but Ray, your promise was interest-free loan, don't have to pay it back at all. But then you said, you don't have to pay it back at all if you don't want to. That's correct. Savvy real estate investors know that when you die, you get a step up in your basis. So even if you bought something for $10 and it's worth $100 when you die, the basis goes up to $100. So if you sell that property the day before you die, you've got a $90 gain. If your kids sell it before even you're in the ground, and after you die, you have no gain. So what happens there? Notice here, after a sale after death, you come back and you say, okay, you sell it, your basis is $1,875,000, you get you have no tax on that because there's no gain on it, and you end up with $1,875,000 as your net. But if you're the savvy real estate investor who plans ahead, you sell it for 3.2 million. Actually, say your kids sell it for 3.2 million the day after you die. Their basis is 3.2 million. Their net is 3.2 million. They pay no tax. That $775,000 just went away. Interest-free loan, you don't pay it back until you want to because you elect to, or you don't pay it back at all because you allow the step up in basis. That's what savvy investors understand. And those are pretty powerful returns on basic investment schemes, not because because the real estate was any different, anything like that. It's the structure. And if the first three rules of real estate are for realtors, location, 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 4, 5, and 6 are structure, structure, structure. In other words, you got to structure these deals right. And it's not tough to do, and that's what we're going to talk about. Any questions so far on that, understanding what the investor does?
So for a $200,000 plus, I guess, increase in your dean, let's call it, you're able to instead pull that back into your investing, leverage it to the degree that it increases your net return by
That double.
about $1 million.
Yeah.
And ultimately, you never had to pay it back. And this started out, I always thinking, geez, this is really unfair.
I'm not going to get social here.
That's amazing.
It's an amazing thing. Okay. That's the basic understanding of what savvy real estate investors do. That's what they're asking about. That's what they want to know because they know about that deferral. Okay. Let's go into a few of the basics. And now we're going to go into okay, what's required to get that? I have a hard time trying to remember all these different rules, but if I can stick a story in with it, then the story makes it so I can help remember. 1031 started out with a case called Starker versus United States. Without going into a lot of detail, the Starker family owned timberland up in Oregon. They sold it to the paper company. You value timberland by how tall the trees are on it. They said, hey, the Starker family said, hey, we want to get back into timber. Why don't you just, instead of giving us the money, why don't you keep the money for us? And in a couple of years, we'll tell you where we want to have you buy some additional property, which they did. The courts got a hold of that and said, okay, fine. How long do you hold the money for? Well, about 5 years. Really? Okay. Well, did the trees grow during that time? Yeah, they did. We'll have a growth factor kind of thing. Well, didn't you really, you say you sold a piece of property, but you really didn't get a piece of property back. You got a contract, a piece of paper back that says, I'll buy you property in 5 years. Sold real estate, bought paper. That's not right kind. Court said no. They went into appeal. District Court of Ninth Circuit Court said yes. And Starker became the law of the land. That you can do those things because that little piece of paper, as long as it's to buy property, then it's going to be property for property. Okay, that little background. Here we go. The IRS, they had to respond to that. And they came in, they said, okay, fine. We need to set up some rules. And now for those who are at home, we have this little quiz. If you go up to Snowbird, there's a tram. And if you look who made that tram, it will come out of a place called Thun, Switzerland. Thun. It's a little city just south of Bern, Switzerland, that makes most of these. For those who are watching this virtually, I need to have you email to registration@summitexchange.com your name and the word Thun, Thun. Thun is on the way to the Matterhorn. That's why it's there. Okay. The IRS adopted 1031. It's actually been around since 1923, but we're going to look at one sentence and we're going to take that sentence apart, which will tell us the parts. Again, let's not get lost in the detail. There's going to be about 4 or 5 little simple couplets to remember that will tell you all about the sentence. No gain or loss shall be recognized on the exchange of real property held for use in trade or business or for investment if such real property is exchanged solely for the real property of like kind, which is to be held either for productive use in trade or business or for investment. Try to say that in one breath. Let's take a look at it. The first requirement, you have to have an exchange. No gain or loss shall be recognized on the exchange, meaning you have to give something up and receive something. The simple little couplet is give a deed, receive a deed. people will call me and say, wait, I got this great idea. We're going to sell this real property, and I'm going to pay down debt on other property I own. Isn't that an exchange? Well, you gave up a deed, but you didn't receive a deed. And so the answer is no, there's no exchange. You can't use 1031 funds to pay down debt on property you already own. Someone will come to me and say, Ray, I've got this great idea. I've got this piece of property I'll sell, and I've got this other property I already own, and I'm going to build a building on it. That's real property, isn't it? Yeah. Did you give a deed? I did. Did you receive a deed? No. I just have more real estate. I did not receive it. So the general rule is you can't use exchange proceeds to build improvements on your own property. Now, I say that and say wink, wink, wait till the second hour, and we'll show you how you do build improvements on your own real property. But the first is you have to have an exchange. Give a deed, receive a deed. The second requirement is the real property requirement. No gain or loss shall be exchanged recognized the gain on the exchange of real property. It's only real property. It has to be some form of dirt. Okay. It used to be we could do exchanges on personal property up until 2017. Think about it. What do you think the most common exchange was back before we could do that? Airplanes, railroad cars, Hertz rental cars. Hertz buys 1 million cars every year, takes them through their 3-year-old cars and sells them every year. They were paying tax on all those. When they set up their exchange, they saved $86 million the first year. Jeez. Big time numbers. Point being is that no longer the case. It has to be real property. And when you think of real property, it's based upon state law. There's one significant exception to that, and that is a 30-year lease is the same as having a deed to a property. Tuck that away. We're going to talk about that in a little bit. So the couplet there is only real property. Okay, so got to make sure you own real property. The next requirement, the first held for requirement, no gain or loss shall be recognized on the exchange of real property held for use in a trade or business or for investment. Okay, you have to have held the property. Relinquished, we call this the relinquished property holding period, the one you're going to be selling. Now, what does that mean? It has to be investment property. What's investment property? There's really no definition of it. It's easier to tell you what it's not than what it is. It cannot be your personal residence, personal use property. It can't be your vacation cabin, vacation home, anything along those lines. They don't constitute investment property. They constitute personal use property. The other is you have to hold it for investment. If you're simply holding it for resale, that's called dealer property. It doesn't qualify either. What's that mean? Well, a dealer is somebody who's the buy, fix, flip type. I'm going to go buy the little home. Maybe it's a little bit run down. I go put in new carpet, new countertops, some cabinets, maybe a roof, turn it around 3, 4, 5 months, and we sell it. That taxpayer bought that property with the intent of not to hold it for investment, but to hold it for resale. That's called a dealer. All of your subdivision people are out there selling lots and that kind of stuff. They're selling dealer property. Now, can it be investment property? Yeah, I can go buy a lot and decide to hold it for a while. The test is, what am I thinking at the time? It's a subjective test. In other words, do I have investment intent? How does the IRS test for that? They don't just ask you, well, what did you hold it for? That's a pretty easy answer. They will look to circumstances around. How long did you hold it? Did you immediately turn it in and put it listed the property to resell it? Those type of things indicate intent to resell as opposed to an intent to invest. There is no hard and fast rule how long. 2 years is kind of the unwritten rule. The IRS has indicated they will not question intent if you've held a property for 2 years. Now there's circumstances all around, there's something too long, too short. But as a rule of thumb, that's what we like to see. Does it happen less than that? Yes, it does. Is there investment intent? Yes, there is. The IRS does recognize, the law recognizes that there can be independent and subsequent events occur which can change your original intent. And they would say that's fine. What would that be? Here's your case. You just go in to buy the property in the title company, you buy the property, you close the deal. You're going to say, I have these pure thoughts. I'm going to hold this property investment. It's a gusher. I know it's going to take a couple of years for it to happen. All those kind of things. You walk to get in your car. Somebody approaches you and say, that's exactly the property I wanted. I'll pay you double if we turn around and go back in and you sell it to me right now. Did that person hold the property for investment?
He intended to.
And that's the question. He had the intent. Did independent and subsequent events occur? Namely, somebody approach him in the parking lot and say, here's double the money? Yes. You can defend that situation. It's probably not very unrealistic. And so if you have a short-term hold, as savvy real estate professionals, you're going to want to document that. You say, okay, fine. Let's go, we can go back in, but I want you to sign something that you didn't know me beforehand. We never planned this beforehand. You came in and these are the reasons why you wanted the property and why you didn't get it the first time, those kind of things. Now, it may be in your case that, okay, you bought the apartment and you wanted to hold it for a while and the market changed dramatically. I mean, there's been a big change or something like that. Those are the kind of things you ought to be thinking about. In any event, 1031 only applies for property held for use in a trade or business or for investment. That means you have to have a holding period. Time is your best friend there, although it's not the exclusive answer. That's called the first held for requirement because it applies to the relinquished property. The second held for property is the same test, but it applies to the replacement property. In other words, the one you buy. So that's why the fix and flip person, he bought it, but he didn't ever hold his replacement property. He immediately went to sell it again. If such property is exchanged solely for real property of a like kind, which is used either in a productive use in a trade or business or for investment, it's the identical rule. So it's very simple to remember that investment intent has to apply to both the property you're selling and the property which you're buying. Very good. Any questions about that? That's probably one of the biggest challenges, if you will, realistic challenges, is the nature of the property's been held for investment and doing it and have been held for long enough time, especially in hot markets like we have right now in Salt Lake and in Utah, frankly. There's a lot of incentive to flip properties. And can it be done? Yes, it can, but we would, like I say, we want to work on is developing the facts that there really are there. You have to be very careful about that. So we're careful about that.
So I do have a question.
Okay, go for it.
So I know some people that are selling the home of their folks and they're all getting a portion of that. Would this work for something like that where they haven't lived in it? And what about the one child that lived there for a while to help mom out? Would that work for them?
Excellent question. I like to have some factual things like that. And the answer is probably not, but probably doesn't need to. If mom and dad have passed away, they get the step up in basis. So if the kids sell afterwards, then there probably isn't too much of a gain even to be sheltered there.
Okay.
But let's go back and say what happened there. Well, first off, personal use property, well, it was mom and dad, but they had somebody in there. Somebody took care of them. That's still beyond just mom and dad's use. So that's their personal residence, but because they let somebody stay there for free, maybe to help take care of them, they don't have investment intent. They're just using personal use. What's oftentimes the case where you'll get into the situation where it's like dad has daughter who goes off to college and dad says, hey, I'm just going to go buy a condo and daughter can stay there. And that way, maybe I'll make some money. And but at the same point in time, I will, have an investment. Well, unless daughter is paying fair market rent, that's not an investment property to dad and will not qualify for a 1031 exchange. You have to test. The simple test is you have to rent it to the family member the same price you're going to rent it to me for. So as a third party. So
Thank
I
you.
got a question about step-up basis. How's that documented? Who documents the step-up basis?
your accountant does when he files your tax return. And then that's what we'll do. And oftentimes either we'll get an appraisal, a date of death appraisal, or some kind of, maybe an MAI appraisal, or maybe something less than that, maybe just a real estate appraisal, depending on how much they have to defend it. But yeah, that's done and documented on the tax return that the accountant prepares for it. Okay. Any other questions?
It comes down to time, intent, and purpose.
Mm-hmm. And you have to have pure thoughts, be a real Boy Scout about those thoughts. You know, say, I am here for as an investor. And the thought would be is this, and I tell my clients, I say, well, we may want to move into this property or whatever it is. And they say, no, what you want to be thinking is I've got a price of property. It's a real nice piece of property. I'm going to hold on to it. I don't know what the future is going to bring. I'm just going to hold it for a while. And perhaps in a year or two, I'm going to change my mind. Maybe somebody's going to come and offer me a price I can't refuse. Maybe somebody's going to say, this, you know, wife's going to say, dear, this is where I want to stay forever. We're going to build a house. But that decision isn't made until down the road. We're just simply holding the piece of property. You know, again, we'll just see what the future brings. And that's probably your strongest argument to say is, we don't know. It may change. And frankly, it does. You talk to a lot of people, they get a change in work. They may have a change in retirement. Somebody wants to go live, you know, someplace else for their retirement. All those kind of things work. So the idea is, no, I'm buying this property and we'll see what the future brings. That's what investors do. Okay. We'll move on here because we're going to do it in kind of two sessions and get the first hour in, and then we'll have a little break and then we'll come back. Next requirement, the like-kind requirement. If the real property is exchanged solely for real property of a like kind. Now, this is probably the most misunderstood and the lowest threshold requirement of 1031. Everybody, I get all these calls. Ray, I sold a duplex. I cannot find a duplex. Or I sold some farm property. I don't want to be a farmer anymore. I want to go get a rental. But is that like kind? The answer is yes. Any kind of real estate is like kind with any other kind of real estate, except for personal use property and dealer property. So yes, the farmer can sell the farm and buy a skyscraper or industrial property. It can be income producing versus non-income producing and vice versa. All of those things qualify. It can be property, which it might be somebody uses. And in fact, that's one of the questions we oftentimes get into is that, well, you know, really what I want to do is I'm going to go buy a condo down in St. George, and I want to go down there maybe a couple of weekends out of the year. And does that qualify for being a 1031? What are you going to do with the rest of the time? Well, I'm going to put it into a rental pool, but I just want to have the right to go down there. That's kind of a line between, is that personal use or is that investment? The rule is you can utilize your own property the greater of 14 days per 12-month period or 10% of what you have it rented. So if you're going to go buy the St. George condo, you say that's fine, you put it in the rental pool, go spend a couple of weekends on that. Don't go exceed the 14 days and you're fine. And it's only for 2 years. After the 2 years, investment intent goes away. We don't have to worry about it. And that's all permissible. So yes, you can have a property which you buy, rent, and either move into or use as your vacation cabin or whatever it may be. Most people, when they come to me and they say, oh, I'm a buy, fix, flip, like I talked about before, I say, no, you want to be buy, fix, lease, and then flip. Get some a little bit rental time involved there. In any event, all real estate is like kind to all other kinds of real estate, and a 30-year lease, once again, I bring that up because it's important later on, is also considered to be real estate. So I can sell a property and I can get a lease back where I'm the tenant. If the term of that is more than 30 years, that's a valid exchange. You say, well, why would I ever want to do that? That'll keep you coming back for the second hour. Okay. Okay, next requirement, identification periods. You have to identify your potential replacement period, replacement properties within 45 days after the sale of your relinquished property. Sale meaning recording, not contract signing, recording. If you have multiple properties, which you can do and sell like 2 or 3 and then go into something, that 45 days starts with the first sale, not the last. There is no forgiveness about this. No Saturdays, Sundays, none of that. No dog ate my homework. It takes a presidential act of declaring a disaster to get that extended. And it happens on, they had a COVID extension back last year, but it doesn't happen very often. And that's where you can step in and help your clients. You can be looking for properties before the other one even sells. You can put them under contract. Again, it's the recording. But that's where, like I say, you've got 45 days to nail this down, which is too short, frankly. But remember back in the Starker case, how long did they hold the property? 5 years. That's why that's what the response was, why it's so short, is to say we can't do that. The identification has to be written, signed, and delivered to the, usually it's to the qualified intermediary. When we do these, we have a form they just fill out, and it's nothing tough. It's, I mean, finding the property is tough, but just basically putting in addresses and so forth. It has to unambiguously describe, so you can't say, well, I want a lot in the Shady Acres subdivision. That doesn't do it. Well, I don't know which one I want just yet. Well, you got to decide. You can say lot 36, that's fine. The description of the, and if you are going to do a property that's going to be produced, it's going to be built while in the term of this exchange, you have to describe those improvements. So you're going to build a Rambler on it, 2-bedroom, 3-bath. Again, nothing too extensive, but it has to be clear that what is something that does not exist. Now, the 3 property rule or the 200% rule. Here's where some confusion comes into play. You have to satisfy either one of those, not both, but either one. The 3 property rule says I can identify 3 properties of any value. So it can be the Taj Mahal, it could be, you know, you name it, it's the United States, you can buy it, it doesn't matter. So that's usually what most people use, the 3 property rule. Alternatively, and these are usually on larger deals, you can do what's called the 200% rule. If you sell something, say for $5 million, you can identify as many properties as you want, 4, 5, or 6, because that's only where it matters is above 3, because you use the 3 property rule otherwise. But 4, 5, 6, 10 properties, whatever, as long as the value of the 4, 5, 10 properties does not exceed twice the value of the property sold. I sell something for $5 million, I can identify 10 properties, as long as those 10 properties, when added together, don't exceed $10 million. 2 times the sales price. Like I say, most people do the 3 property rule. Larger deals, the 200% rule works out well. It also works out well, like I've had deals where they're going to go buy a whole bunch of lots, and maybe it's in Panguitch or something like that. So they're $10,000 lots. Each one of those is a different property. So the 3 property rule will not help you. So you say, okay, fine, I'll buy 20 of those lots at twice the value. So then even though it's 20 properties, it's covered. No offense to the people who are selling Panguitch lots. That's it. Any questions about that? Like I say, that's really where I see professionals can be the most helpful in helping them identify, recognizing and providing some alternatives and getting it in. Again, there's no forgiveness. I don't mean to underestimate that. You don't have a Saturday rule or a weekend or a holiday rule. On that 45th day at midnight, if it can be emailed in, but if it's not in, there's no hope. There's nothing I can do to resurrect something that hasn't been identified. So I just emphasize that. Okay, moving on. The receipt requirement. You have to receive the property. Has to be within the earlier of 180 days of the initial conveyance, again, when it records, or the due date of the tax return of sale. That sounds like such a silly thing, and it is. But let me show you how that can be a real trap, and you have to work with that. If you sell your property on December 31st, you would think, oh, I've got 180 days. And the answer is no. You have 180 days, or when your tax return is due, which is April 15th for individuals and March 15th for limited liability companies. And as soon as you file that tax return, your exchange is over. So exchanges which happen after October 16th, which is 180 days from April 15th, have to fall into this trap. How do you get out of the trap? You file an extension. If you file an extension, it goes back to the 180-day rule. So make sure your clients are aware of that, especially in that last quarter of the year, to make sure they don't fall in that trap. Again, there's no forgiveness here. And the no forgiveness is it has to record within that 180-day period. So if your 180th day is on Sunday, you don't get the benefit of the weekend. You have to close and record on that Friday. So that's why it's important to know. Any questions on that? And then just for clarity, it's the 45 and the 180 run simultaneously. So you don't get 45 and then 180. You have 45 and 135 actually. Okay. Again, that's in response to the long time period that the Starker family held the property, held onto the money. Okay.
Yeah, I had a question about the 45-day rule. I put it in the chat, but I'll go ahead and ask it. Say you don't find a property and you're at day 40, can you decide to roll it into a Delaware state trust?
Yes, the Delaware state trust is determined by Delaware law to be real property. And oftentimes one of the investment strategies is you may pick your first and second, real picks. And then your third choice may be they're called DSTs or a tenant in common, either one. But that basically is like a fallback to say that if nothing else happens or everything goes badly, I've always got one replacement property which I can depend on being there. So the answer is yes.
Thank you.
You bet. Okay. Now, going back to the Starker case, one of the real issues they said is, well, who had control of this money during the 5-year period? And if you had the benefit of that money, that's the same as if you received it. That's called constructive receipt. Constructive receipt's like when you have a good year and you're going to your boss and the boss tells you on December 31st, he says, you had a great year, here's your bonus check. And you say to him, you're right, I've had a great year. I really don't want to have any more income this year. Why don't you keep that check until January 2nd? Because you had the right to receive it in December, whether you cashed it, picked up the check, whatever, the fact that the check was presented makes it so that you're in receipt of that money. That's called constructive receipt. If your client receives cash at a closing or has the right to receive it, that's constructive receipt, taxable gain. Qualified intermediary is somebody who's designated under statute. Basically, it says you can send the money to the qualified intermediary, which is lots of fancy words, but all it is a tax-wise escrow. If the qualified intermediary holds the funds, it is not deemed to be held by the taxpayer and therefore no tax. You can do the exchange. That is why it is absolutely essential that you sign the exchange agreements at or before closing on the property, because that sets up this arrangement to say it's not constructively held, it is held by the qualified intermediary. In those exchange documents, it basically there's an assignment and transfer which triggers all the regulations, which make it so it's non-taxable. Lots of paperwork, but that's really what's going on. It's a restricted tax-wise escrow account, so you just can't go in and say, well, give me my money back. The qualified intermediary can only disperse those funds in like 4 situations. 1, obviously to buy property. 2, at the end of the 45 days, if they have not identified anything. In other words, they have no potential of doing an exchange. 3, so let's assume they identify one property. They close on that property after the 45 days and there's excess money. But there's no further opportunity to do an exchange because they only identified one property, the 45 days expired, they can't fix that, then you can expand it at the end of the 180-day period. So what that means is a lot of investors will come in and they'll set up the exchange, whether they know what's going to go, how's it going to go or not. But what they do is they want to buy the flexibility. It gives them 45 days to figure it out. If they say, hey, there's nothing here, I can't do it, they intentionally don't file the identification. They receive their monies after that period. They're taxable gain, but there's no penalty for that. They say try, but no penalty. What is concerning is if they put down 2 properties, they buy the one, they have excess funds, but they say, I really don't want the second property. I really don't want it. Well, Doesn't matter what your intent is, because you have the potential of being able to buy that second property. The qualified intermediary can't release the funds until after the 180 days has expired. And that can be a kind of a rude awakening. Sometimes people say, well, I was going to get my $100,000. We're going to go to do whatever. You say, well, I'm sorry. And if you do, if the qualified intermediary distributes that jeopardizes, in fact, you lose on the first exchange, on the first property, it doesn't qualify. These are real rules. You have to deal with them. You have to know about those. Direct deeding, even though the qualified intermediary steps into the shoes of the taxpayer and receives the money, the deeds go directly. In other words, the seller deeds property to the buyer and vice versa. It doesn't go through the qualified intermediary. Okay, we're almost here at halftime. Last couple of things. It's called the same taxpayer rule. The taxpayer who has historically owned the property, who has held it for investment, in other words, satisfied that first requirement, is the one that's entitled to do the exchange. So if husband has had the property and turns around and sells and wants the wife to buy the replacement property, they're different taxpayers. That just invalidated exchange. Sounds strange. I was on the phone this morning when that was exactly the deal that was going down. So you can't do that. So they're working around it. You have to be careful too, and specifically with respect to partnerships and LLCs, which most real estate is held in an LLC or a partnership. The partnership or the LLC is the taxpayer, not the members. And we'll talk about the situation where you get into Jeff and I go together, we buy a piece of property, it's 50-50, make money. We're going to say, okay, we're going to go do something separate. Well, it's not Jeff that can do the 1031 exchanges. It's not Ray that can do the 1031 exchange. It's our LLC. So we have to stay together. There are ways to get around that, but that's the problem. Husbands and wives are different taxpayers. So my example about the husband and wife, as long as if you're in a community property state, which is like Washington, Oregon, California, Idaho, and Arizona, and Wisconsin, well, I don't know how Wisconsin, but they did, then they are considered to be one taxpayer, but that's where. Single member limited liability companies, I simply note those because they're an exception to the rule. If you have a single member limited liability company, even though you buy the property in that single member limited liability company, it's deemed that the owner of that LLC is the taxpayer. So for example, Ray Beck can go sell a piece of property and I can form Ray Beck LLC and be the sole owner and buy my replacement property, and that's the same taxpayer. A single member limited liability company is called a disregarded entity. It doesn't have to file a tax return, and so it satisfies 1031. There are numerous uses of those, and we'll talk about that mainly in the second hour. So you have to, I note that right now just so we can explain some more later on, laying some groundwork. Okay, but that's the same taxpayer rule, and it can get you hung up. You need to be thinking and tell your clients to be thinking about how they own the property now. So you don't want to be shifting around things and say, oh, I wanted to give it to my wife, just before we sold. You just killed half your exchange because husband only owned it, gave half to the wife. She hasn't held it for investment. Only the husband has. You just lost half your exchange. Little trip ups and things like that can happen on that same taxpayer rule. Okay. Lastly, and then we'll take a break. Their accounting and boot tolerance rules is what they're called. There are volumes. The regulations are very extensive on these accounting rules. Basically, however, you can consolidate it down into like 3 little sentences. In order for have a perfect exchange, you have to have property, you have to go buy property which is equal or greater in value than the property you sold, have an equal or greater amount of debt, and spend all the cash. It's not just the profit. Too many times people say, I bought the property for $100,000, going to sell it for $200,000. I'm just going to roll over my $100,000 worth of profit. Doesn't work. The IRS views that you just rolled over your $100,000 of basis and you pull out the $100,000, that's taxable gain. Gain dollars come out before basis dollars come out when you're pulling money out. So let's give a real simple example here. You sell something for $100,000 it goes up to $200,000. Okay. And let's say you went and had to go borrow some money. You borrowed $75,000 in order to do that. For a perfect exchange, you will have to go find a property worth $200,000, have $75,000 worth of debt on it, and will have had to spend your $125,000 of cash, which you got out of the sale. So on the sale, $200,000, the money comes down. The first thing the title company does is go pay off the loan, $75,000. They send the $125,000 to the qualified intermediary. When that goes to buy, you have to go buy something for $200,000, go get another loan for $75,000, and spend the $125,000, which the qualified intermediary is holding. So it's equal and greater value, $200,000, equal or greater in debt, $75,000, spend all the cash, $125,000. That's the theory. Now, we know when you go to closings, there are expenses. So usually when you sell for $200,000, you don't necessarily get $200,000. Okay, you have commissions, title insurance, whatever it may be. That's permissible to pay that off. And so maybe they say there's $10,000 worth of closing costs. So you sell for $200,000, 10 of it goes to the title company and others, the real estate professionals and so forth. That's okay. I only have $115,000 worth of cash after we pay the $75,000 loan. Fine. In theory, it's best to go get a $200,000 property. There's always a benefit for going up. But in practice, yes, you're going to have a $10,000 gain because you didn't buy $10,000 worth of property. You only bought $190,000 in our scenario. But you also get a deduction for the $10,000 of different types. It doesn't match up exactly, but it doesn't, usually most taxpayers don't care. And the only way to get around it is you take money from another source, in other words, money that you've already paid tax on, to go pay that real estate commission. To the extent you trade down, let's say you forget the commissions and all that for right now, you only buy a $190,000 property. You'll only pay tax on the 10, just the trade down. It doesn't invalidate the entire exchange. So it doesn't have to be perfect to be very, very good. And some people will do it. I just want to go take the kids to Disneyland or something. And they'll pull that money out at the first closing, recognizing that's going to be a taxable gain in doing it. If you go up, no problem. Now, note here the tax rates, which we just talked about before, those tax rates will apply to that full $10,000. So if your client says, I want to pull $10,000 out, say, okay, let's do your tax rates, but it's probably going to be 20% federal and 5% state. So if you want 10,000, you better pull out something around 12.5 or 13 to get to the net to 10, because you got to pay your tax bill with it. But that's permissible to do. Any questions about that? Very good. Let's take a 5-minute break and we'll resume here.
Awesome. Just the chat here.
Hey, Jeff, I would have one question for Ray. If you're in a partnership that owns, like an apartment community, and that sells and you're a member in that partnership, you can't take that. You have to recognize the gain on that first before you can reinvest, and you have to pay tax on that. Is that correct? You can't put your investment portion into another exchange. Is that my understanding?
That's the general rule. We'll, in the second hour, we'll tell you how you get around that.
Okay.
Yeah.
All right. Very good. Thank you.
So basically there is a way to split,
Oh, yeah.
but it doesn't apply to the generality of what the rule says. You got to do extra steps.
You got to do extra steps because, again, the partnership, not the members, are the ones who can do the exchange.
Okay. Very good. Thank you.
Do that. You can hear me and I'm projecting okay as far as the sound and that? Good. Okay.
can't, my cursor doesn't move on there for some reason, I can't see it. I'm sitting there swiping the wrong thing. Can you maybe pull your laptop up here so you can check the chat? Yeah, because I can't open it on here. That's some clean glass, isn't it? Some of us have been moving a lot faster. There's been times where she's sitting right there looking at me white. She doesn't know what over here. Funny. So, good stuff, huh?
Awesome.
I don't know, the second one, this just kind of gets you primed up. It's like,
Yeah.
Deferred, and then the strategies. On that little thing, it has little bubbles. It has a one. I think it's just.
Yeah.
That is an awesome property.
So you can see some chat.
It's awesome. I had no idea about.
Because I know
Some good content. So you keep saying, is it savvy investing?
Somebody who's smart, somebody who's doing it.
Yeah,
He's
yeah.
savvy.
Yeah.
It doesn't stand for
So
anything.
do you, what do you do first?
Just unqualified. I structure the business. I don't sell real estate. I buy lease.
You just set up the deals.
Sell it.
Cool. And how long have you been doing this for?
That's a imposing question. The regulations for that type too.
This first round, like, we're gonna get your roll here. This CCTV, what do you like?
It's gonna be yours.
Yeah. It's awesome. So is there more, is it just, do you own the company then, or do you?
Family, yeah.
Nice.
I'm just letting everybody know that we're going to be starting again in about a minute or so. So if you want to kind of start gathering back, it'd be good. I'm going to start up here in a minute or two. Yeah. Oh, no.
As soon as Ray starts talking, you stop.
I just get a general announcement to say we're going to get back together. So the people who are at home.
Probably have another email to ask for.
Next.
Yeah.
That's why I want to get people
That's
there.
clever. It's clever to do it that way.
Yeah.
Well, not clever. It satisfies questions, right?
And it makes it so, here's proof. You either did send the email or you didn't. I'm not going to.
I mean, it's great that it's CE class, but in my opinion, it's like the education, it doesn't.
Yeah.
You don't want to not know this stuff because it's not a CE class. You know what I mean?
Exactly. I mean, that's why I say when I say about the salary, it's really true. I mean, I've got clients who've been doing this for years and years, and it's my, we closed a real estate as an apartment deal, $178 million. And we had three of all three of the parties were doing exchanges.
And they all went into the one. Nice.
Yeah.
Nice.
So I mean, it's just mind-boggling that the amount of money that saves.
I know, right? When you're talking those kind of numbers.
Yeah. So. Okay, we're about ready to start again. know who this person is. I don't know.
I know for some reason, I don't have the mouse plugged in and so I can't move. I'm not moving
Can't move
anything.
around.
Yeah. So speak up if you have a question.
Yeah. In fact,
but we're gonna get going.
let's do that while we're gathering here. If there's any other questions you may have, or
And Sydney's actually monitoring the chat for me. Just make sure you're sending the chat to everyone and not a private chat, and she'll be able to see that, and we can ask the question from here.
so,
I think they're good to go.
we all there? I hope so. Here we go. Okay, we talked in the first session primarily about the statute and the intent, you know, that the philosophy, if you will, of doing a 1031 exchange. And again, I will do a quick review here at the very end with respect to those little couplets. I don't expect, and I think it'd be mind blowing if you try to retain all this you're going through. It's more, again, that stressing that fact that, oh, there's a potential exchange here. There's, you know, have they ever thought about this, and talk to them about it, because you'll see those opportunities will come to the fore. The first section is mainly just giving all these different rules, and that sounds kind of burdensome. The second session, this next hour, is specifically intended to give practical as to how it works, but also how to how much flexibility is in that. Let's take care of a little house cleaning here real quick first. Just south through the Alps from Thun, where they make the gondolas, is a little town by the name of Visp. It is on the way to the Matterhorn. And if you want to go to the Matterhorn, unless you come from the French side of Switzerland, you pretty well have to go through Visp. And it's a delightful little town, but that's our code word. So if I could have each of those who are listening to email this word with your name to registration@summitexchangeservices.com. That way we can verify that you rejoined us for the second hour of this presentation. Again, but this, again, we're trying to get to the summit here, a little pun intended. That's one way to do it, through that.
Can you repeat that word again or spell it?
It's right there on the screen, VISP.
Oh, VISP. I see it. Okay. Thank you.
That's the name of the town. So,
Can we put all of these together in one email at the end?
well, we were hoping you would do it at the time, because we can tell when you send it, and that makes so we can verify that you were there at this time, and as opposed to just doing it at the end, because you could come in theory, you could have gone to the grocery store and 2 hours later come back and put these two words. So that's why we're encouraging people to do it now, if you would, please.
Thank you.
Yeah, so, yeah, we're just trying to comply here. Again, if you'll put your name and just that word, Visp, being the one.
And just to clarify for you guys that aren't in Utah, this class is just certified for Utah CE classes. So if you guys in Oregon and Washington, Idaho, sorry, it's good education, but you don't even have to send the email.
Okay, good. With that, like I say, if you'll take care of that registration, we'd appreciate it, because we just don't want to have that be a hassle for anybody. Let's talk about practical, how this works. Now, let's start with a very basic exchange. We call this a basic forward exchange, where you sell property, then you buy. Here's how it would work. You've done your work. You've got property under contract. You've got the title company underway. They produce a title commitment. We act as a qualified intermediary. That doesn't mean you have to use us or anything, but I will use the term I or we, and you'll know what I'm talking about there. But in any event, to start off, we need to get a copy of the contract and the title commitment. Then we go to closing. We prepare all the exchange documents. At closing, the relinquished property, in theory, is transferred to the qualified intermediary, who then turns around, having stepped into the shoes of the taxpayer, and sells the property to the buyer. This is the first step of the relinquished property. As we talked about before, the deed does not need to go through the qualified intermediary. I don't know what this property is. It could be Love Canal. It could have environmental hazards on it. I don't really want to touch it. You may not want me to touch it, because I may have judgment creditors against me. I file for bankruptcy or all those kind of problems. So we avoid that altogether by just having, it's called direct deeding, So the property, even though you sign the exchange agreement and in theory I've stepped into your shoes, in reality, the deed goes strictly from the seller to the buyer. The exchange proceeds, excuse me, the exchange proceeds are then the title company is instructed to deliver those not to the taxpayer, but to the qualified intermediary. To the extent that they are delivered to the taxpayer, even if they give a check and say, oh, can you get that back? That's constructive receipt. So we're very careful about making sure that those exchange proceeds do not go to the hands of the taxpayer, they go into the qualified intermediary. The taxpayer then has the 45 days in order to go ahead and identify the properties and 180 days to go sell or to go buy. When that occurs, the same process happens. We need a copy of the contract and the title commitment sent to us. We send additional escrow instructions to the title company. And then what happens is we send the money to the title company, which disperses it to the seller of the replacement property. And the seller, again, using direct deeding, not going through us, but around us, transfers the property to the taxpayer. This is a bit of a fiction. We understand that. That's what tax law is about, quite frankly, in many respects. But notice here, everything we did is say from the taxpayer's point of view is that he gave up property, he received property. If I were to draw a diagonal line from the bottom left-hand corner up to the top right-hand corner and had that be a wall, you'll notice that the money never gets on the taxpayer side of that wall. That's what the qualified intermediary does. The real estate does. That very simply is a basic forward exchange, which allows you to accomplish, all the benefits we've just talked about for the first hour. Now, here's where we can get creative. And I've been doing this. Somebody asked me in the break how long I've been doing this. We started doing this in the mid 90s. We actually did it in the 80s, but then we didn't have all the regulations and we didn't have the blessing of the IRS. And so it's been wonderful to have, it's been interesting to see how the IRS has provided guidelines and taxpayers have responded to them to provide a great flexibility. I usually go to these seminars and I'll have several people just like, oh, I never knew you could do that. How would you do that? Or how can you structure it? And frankly, there's quite a few alternatives that we have. Let's start out with a couple of those. The first one is called a reverse exchange. These apply when you have, you need to buy the replacement property before you can sell the relinquished property. So now, how does that occur? A couple of principles that might have this make sense. First off, remember how I said it's when you receive the deeds and then you give up the deeds, which is critical? Well, in this case, if the taxpayer gets the deed before he sells his relinquished property, his exchange is over. He can't utilize that property in the exchange. And so what a reverse exchange does is called a parking relationship. The taxpayer simply parks the property and holds it until he's got the other property sold, and then he can as a captive buyer. How does that work? Remember the second principle I told you about. That is the single member limited liability company. So what we do is, as far as this, it's basically a tool. It's a flexibility tool. In a reverse exchange, the first thing that happens is the qualified intermediary forms an LLC, which is known as an exchange accommodation title holder. That's a long word. They just go by the first letters. It's an EAT is how they refer to it in the industry. This is owned by the qualified intermediary, but is not a taxable event, nor is a tax paying, or has to even file a tax return in doing it. So we form the EAT. The EAT then goes out. He has to borrow some money because he has no money coming to the table, but he uses that money and then goes and buys the replacement property from the seller. So we're just going just backwards here. That's why it's called a reverse. We're buying first. The money goes to the seller. The title to the property goes to the EAT. Who can that lender be? That lender can be anybody who's willing to lend the exchange accommodator the funds. It can be a bank. It can be, your mother-in-law. It can be money which you have yourself. Any of those, as long as it's a legitimate loan, Those funds come in, and it has to be a legitimate loan because we're buying property here. It has to have real property, real money. And so they basically just buy, the EAT buys the property and parks it. That's why it's called a parking relationship, parks ownership. Note here, it's owned by the qualified intermediary, so that's not the seller, or that's not the taxpayer. So it's as if the taxpayer has not ever known this property, even though in most cases, the seller has arranged or guaranteed or provided those funds in order to do it. We have to then go sell our relinquished property. This is what the taxpayer will do. You have the same 180 days to get that done. So a reverse exchange takes 180 days. But the seller, just like another relinquished property, the title fictionally goes into the qualified intermediary, goes to the buyer. So we sell that. The buyer turns in his money to the qualified intermediary. The qualified intermediary says, I've got a loan here. I've got to go pay off my lender. So he turns around and he takes those funds and pays off the lender, whether it's the mother-in-law, the bank, who knows what it is, but he pays that off. So now he owns that property free and clear. To complete the exchange, the reverse exchange, the qualified intermediary then assigns the EAT to the taxpayer, meaning there's not necessarily a deed, but the ownership of the EAT is transferred to the taxpayer. Because it's a disregarded entity and the taxpayer receives it as a single member limited liability company, that's just the same as if you would have received a deed for 1031 purposes. Why do we do it that way when we could, if you wanted to do the deed? The reason is as follows. There's several. One, when we bought the property, we bought title insurance. We bought all sorts of contractual rights. If I transfer that property to the taxpayer by a deed, it nullifies that title insurance property. And so we just lost the benefit of our premium. Realize this happens all within 6 months. So it's a very short-lived insurance policy. Secondly, this EAT, although it has very unique tax concerns, for non-tax reasons is a perfectly good limited liability company. In other words, somebody slips and falls on that property and wants to sue the owner, they're going to sue the EAT, not the actual owner. So it protects the owner from his house, his first male child, and all those kind of things from liability. And that way I keep it. And frankly, I tell my clients is, to hold your real estate in limited liability account just for liability reasons, not for tax reasons, because it's such a protection. And it also allows us to move them around very easily without having to go record a deed. We can just assign the membership interest. In my documents, that's a 2-page document. So I can transfer lots of value of property around just by having them assign a membership that EAT. Lastly, that single member limited liability company doesn't have to file a tax return. So you don't have to go engage another accountant to go file a return. If that property generates some rental income, it goes right on the 1040, the personal tax return of the taxpayer, but no return. That's what we call a reverse exchange. It allows us to basically be able to respond quickly to hot markets when you basically got a deal and the seller's not going to wait. I've got to buy it now. You can still do a 1031 by using a reverse exchange. Now let's build on that. Let's assume we talked about before about we need to go build some improvements, or we want to build something on there. Let's say you're going to sell a property for $1 million. And what you really want to go do is you've got to go buy a piece of property and you want to go build some improvements on it. That's called a construction exchange. We can usually do that through a reverse. It can also be done forward, but I'm just going to show you the reverse here. So this would be say, okay, if we sell for $1 million, we're going to go buy our lot, a vacant piece of property for $200,000. Because of the equal or greater in value question, that's going to mean you're going to have an $800,000 gain because you only bought $200,000 worth of property. So what do? We do what's called a construction exchange. Note here, we have to be careful, and that's what this does, keeps ownership away from the taxpayer until it's worth $1 million. Just like the other exchange, the qualified intermediary forms the EAT, the single member limited liability company. They go in and buy the replacement property, borrowing funds. That's the $200,000 vacant piece of property in our example. And the funds can come from anybody, a bank or any other party. But then the EAT goes and hires the contractor who's going to go build $800,000 worth of improvements. Even though the EAT is separate from the taxpayer, the rules allow the taxpayer to be heavily involved with that. In fact, completely involved with it. The only thing the EAT does is hold title. So the first thing it is, the taxpayer goes and picks the contractor, picks the architect, picks the carpets, well, you name it, they can do all of that. But the exchange accommodator, in my example, will have that $800,000 and they can fund those improvements. We then go sell the relinquished property. That's the $1 million property we talked about before. The funds, just like in all the other exchanges, come up and become part of the qualified, paid to the qualified intermediary. Those funds can be then used again to pay off the lender, the $200,000. They can also be used to pay the contractor. And oftentimes we will act almost like a construction lender. Every month, the general contractor will send us a bill and we have the $800,000, we'll go pay them off. Again, we are simply passing the funds, and the taxpayer himself or herself is the one calling all the shots. Do we pay the money? Do we get a lien release? Does all the inspections and things like that. So at that point, within the 180 days, that $200,000 we originally spent, plus the $800,000 of construction improvements becomes worth $1 million. And that's the number we need to meet. And at that point in time, we assign ownership of the EAT to the taxpayer, not a $200,000 EAT, $1 million EAT. And that satisfies the equal or greater in value, equal or greater in debt, and spend all your cash requirements. These are, like I say, in my example, I talked about building apartments and things like that. These are much more flexible even than that. The point being is they come in and you say, okay, fine, I sold something for $250. I just found a nice fixer-upper for $200. Let's do a construction exchange. Because if you just sell for $250 and buy $200, you got a $50,000 gain. But if I go and put a new roof on, maybe some new countertops, whatever it may be, it doesn't have to be complete construction. It can be any kind of improvement. All of those things qualify. And notice here, that's part of your interest-free loan that's paying for those improvements. So we do a lot of them that, a new roof or a new carpet or maybe new countertops. It doesn't have to be this massive construction project. But notice here what you can do. You can exactly tailor how much you spend on those improvements by how much money you have with the qualified intermediary. And so you make it show that it can become a perfect exchange with no tax, simply because you can control how much money is going into it. This is a reverse construction where we buy first and start building and then sell somewhere in the middle of the 180-day period. You can do it the other way too. You could actually sell the property, go buy the $200,000 lot, and go build those improvements, waiting for, during the 180 days. So it can go either way.
What's the benefit to doing one or the other?
It's mainly dictated by what the needs of the seller of that vacant lot. If he's saying, I'm going to sell right now, we're going to sell it to somebody else.
Then you would do the reverse.
We do the reverse. The other one's just saying, hey, I'm going to go sell something. I know I'm going to have extra money. I want to go fix these things up. We do a
Time may
forward.
not be an issue.
Yeah.
Here's another reason too, is look at our market right now. Some people aren't selling because they don't know they can find something to go buy. So by identifying what they're going to buy first and buying it first, now they're comfortable in selling their relinquished property because they've already made the acquisition. I know investors that have gotten that situation where they want to sell something. It's like, well, what am I going to replace it with, right?
Take out the risk, especially in, like I say, hot markets like we have here. So, because in that case, just building on that same thing, I know I can sell my property.
Mm-hmm.
I don't know I can buy. This takes that risk out just by setting that
So
up.
you buy the property first and
Yeah.
keep the transfer after.
Another point to
Almost makes you cry a little bit.
It's beautiful.
That part.
Let me just say this too. They're very flexible on the rules. Literally, the exchange accommodation title holder holds title. That's it. The taxpayer can do anything he wants as far as the building and that kind of stuff, and the lender can be anybody you want. Sometimes certain lenders have problems with selling or lending on residential property onto an LLC. There are lenders out there who are specifically EAT lenders. They will take an EAT loan like this. And so they're happy to do it because from the lender's point of view, I can go and I can take a deed of trust against the property you're buying. I'll take a deed of trust against the property you're selling. I'm way over secured, and I know within 180 days, this thing's going to get paid off. So there's some practical things about that, but that's okay. We can work with it. Okay, but let's say you do have one of those lenders that says, I don't want to lend to an LLC. This is a residential loan. I'm gonna have a hard time selling this loan. What we have there is called the exchange first reverse. It's a tongue twister. Basically known as the bank friendly reverse exchange. Because like what a bank wants is they want to make a loan to an individual who has a credit report and a job. LLCs may not have those things. So this is how you do the exchange first. Notice first the name. In the reverse exchanges, which we just did, sorry, we'll back up here. Notice here that the sale of the relinquished property and the assignment of the EAT to the taxpayer are the fourth and fifth steps. In other words, they happen at the very end of the exchange. You could call it an exchange last reverse or exchange last construction. Okay, now notice in this exchange first, we do everything on the first day. It starts as follows. On the first day of the exchange, the lender lends the money to the taxpayer and he buys the replacement property. But he makes the loan directly to the taxpayer. So he's got the individual, he's got the employment record, the credit report, and so forth. And on the very first day, he buys the replacement property. And that's a vanilla deal. There's no exceptions. They don't even care if there's an exchange going on. On that same very first day, the EAT entity, which has been formed, buys the relinquished property from the taxpayer. So on the first day, I sold my property to the EAT and I bought my relinquished property. I've just done my exchange. It happened all on the first day. Since the EAT has no money, it pays 100% financing. So it's 100% notes. In other words, we sell it for $1 million, you sign it, the EAT signs a note for $1 million and transfers title. So on the first day, we've already done our give a deed, receive a deed. What happens after that? They have 180 days for the EAT to go out, and frankly, it's the taxpayer go out and sell that relinquished property. He goes through that closing. So the EAT sells to the buyer. The buyer then transfers the money from that sale, just like in the relinquished property is always the case, to the qualified intermediary. The qualified intermediary then goes off and says, I've got this big loan on this property. I'm going to go pay off the loan because I got the money in. So that money comes back to the taxpayer, whoever the lender is or whoever it may be, but that money gets paid off. And with having done that, notice what we've done. As long as that sale occurs within the 180 days, we've satisfied all the requirements. The bank has been happy because there's lending to an individual, and the loans, the 1031 funds can be paid back to the taxpayer with no tax implication, because the taxpayer is receiving those money as a repayment of the loan, not as a taxable sale. So this is a very common one we use, especially in lending situations. It's good to know you've got that in your hip pocket. So if your borrower has some problems with the lender and isn't wanting to go get an EAT loan or something like that, you say, okay, we'll just do a exchange first reverse. The drawback of the exchange first reverse is you cannot do construction. And this, because see, on the day one, he's received his replacement property. So it's got to be, in my previous example, it has to be worth $1 million on the day one. It can't be to be built worth $1 million. So again, very flexible. Any questions about that?
Can you just speak to the intent and the language that needs to be in the contract for when they buy the replacement property? Because they can't just go out and buy a property.
Exactly. Here, I'll tell you what the language is, and I'll tell you my philosophy. Maybe my philosophy first. My philosophy first is that every real estate contract you sign up should have a 1031 cooperation clause in it, whether they're going to do it or not. And the reason for that being is that it doesn't hurt anything. You're not tipping anything off or losing leverage in the negotiation, that kind of stuff. And you don't know. You sign up a contract, it's going to close in 60 days. Maybe in the 60 days you find out a deal that's going to be an exchange. And so why have to go back and renegotiate or have and do something like that? And so, like I say, and if it's not used, no problem. I mean, have you looked at your abrogation clause in your Rep C lately? No. There's all sorts of provisions in your Rep C that I never apply. So it's fine. The point also is that, you know, you want to make them so they're benign, because you don't want to have anybody be say they're surprised or this upsets them or whatever at closing. A cooperation clause basically says is the Division of Real Estate has their own pre-printed one, which is fine. You check the box. Basically, it's a clause that says buyer and seller acknowledge that each other may be doing a 1031 exchange and agree to cooperate with one another without liability or cost of the other. You can get more elaborate than that, but that's essentially what you're after. Just to simply say, we're going to cooperate, and then they don't have any questions. And none of these things impose costs or liabilities on the other side. They're not, like I say, they're not controversial provisions or something you have to fight for. Sometimes because people don't know all the parameters of 1031, they get fearful about that, and that's almost more the concern what you have in doing that. Okay. So that's your exchange first reverse. The next one we want to talk about, and this really gets fun. Remember we talked about how you cannot build improvements on your own property. In other words, I went and sold the property. I've got this vacant piece of property. I want to build a warehouse on it and go ahead and do it. The case on that is called Bloomington Coca-Cola Bottling Company versus Commissioner. And basically what it was, the Coca-Cola bottling company back there in Bloomington, Illinois, had two pieces of property. They had their old facility on one and a vacant piece of property next door. They came up with a great idea is I'm going to convey both of those properties to my contractor. And they'll let him build a bottling plant on the vacant property. And the way and then they will convey back, and that's how he'll pay us back, is by giving us a new bottling plant on the new property. Their argument is, look, I gave a deed, I received a deed, equal or greater in value, construction, all those kind of things, no problem. Well, the IRS said, no, we think there is a problem. And the courts agreed with the IRS because they said what they're really doing is you're just paying for your construction costs by giving them some vacant property. In other words, the old facility. So that's been the general rule. Now, here's how we get around that. Remember, I've been talking about how a 30-year lease is the same as real property, so you can trade one for the other. We're going to use that principle together with our EAT principle, and we'll have this, see how this works. The first thing you have your taxpayer, qualified intermediary, and so forth. The first step here is you have to have a related party. And usually what it is, you've got mom and dad LLC, and they've got a piece of property that you have a vacant property they want to go build something on. Well, it can't be the same taxpayer. So what we do is we say, okay, let's put mom and dad LLC and put number one child on that LLC for 1%. There's only a very small economic thing there, but it's a different taxpayer now. Still under control, all those kind of things, but it's a related party. That transfer has to happen at least 180 days before we start the exchange. So oftentimes when you get these deals, the first thing we want to do is transfer the property into the child's name or somebody else's name and let it sit for 180 days. But that's what's happened. And so then with the mom and dad LLC, will sell or transfer that to, well, I'll call it the kids LLC, who's a related party via deed, which is not a taxable event. And there's 180 days lapse. Now we go into just do our regular 1031 exchange. We go ahead and sell the relinquished property. The money comes into the qualified intermediary. Nothing new there. Now, what do we do next? We use our exchange accommodation title holder. We form one, and guess what he does? He enters into a lease with Children's LLC. And guess what the terms of that lease are? 30 years. meaning the exchange accommodation title holder has the right to possess that property for 30 plus years. As long as he pays his rent, he can do it. Now, even though we say 30 plus years, it only has to have the potential for 30 plus years. You can have a 2-year lease with 28 1-year extensions. That's 30 years. That qualifies. Why do we do that? Because it gives the exchange accommodation title holder the right to possess the property. What's he going to go do on that property now? He's going to go build those improvements. It's not on mom and dad's LLC's property. And it's technically not even on kids LLC's property because they're the landlord. It's on the tenant's interest in that property, which is a different legal interest. I know it's the same piece of property. Okay, got that. But it's a different legal interest. And so we can go ahead, in this case, had we done this with Coca-Cola Bottling Company years and years ago, the family would have given it to their kids. Kids would have leased the vacant land, the qualified intermediary, the exchange accommodation title holder, hires the contractor, builds the improvements using the money they receive from the sale of the relinquished property. Build, build, build. Now, and how do we finish? We assign the EAT to Mom and Dad LLC. Mom and Dad LLC sold the property. Mom and Dad received the improvements, only the vertical portion, if you will, of that replacement property. That constitutes replacement property. Notice here, there's all sorts of things you can do here. You can do this multiple times. We've got a project right now. The taxpayer, he's a developer type, but he's got large amounts of property that he's selling periodically, so much every 6 months. He also has a business which requires a large and expensive building, $20 million building. So what do? We sell the first parcel of property. We take those funds, we do the lease, we hire the contractor, and he goes and builds these improvements. It may be the foundation. It may be the plumbing or the electrical or whatever it is. It doesn't even have to be discrete. It's saying that's your foundation. You're just saying we leased it. And we assign that over to the parent taxpayer. We then sell the next piece of property. Same thing comes in, we build the second floor, third floor, fourth floor. We're doing that over about a 2-3 year period, which allows us to build on our own property using tax-free funds. Note here at the end, what's happening. You've got Kids LLC who owns the dirt. Mom and Dad LLC owns all the vertical. Well, maybe mom and dad have an estate tax problem. Maybe they've got too much money. They're going to pay a bunch of tax and want to give it to their kids, but they don't want to violate their gift tax exemption. They don't want to have a taxable sale. So what do? They say, oh, I've got this lease here. After 4 or 5 years, we're going to stop paying the rent. What does every lease say when you stop paying the rent?
Eviction.
The landlord gets rid of the tenant and gets everything that the tenant left behind, meaning the vertical. So you basically just transferred millions of dollars down to the next generation without having a tax, without doing a gift exemption. You just had a huge estate tax windfall. You can do that anytime because you've got we set these leases. It'll say, okay, fine. We'll say it's like a 5-year lease with 5 or 6 5-year options. Sometime over the next 20 years, when the kids and the parents are tired of taking care of the business, they just let it terminate. It actually goes to the kids. Doing it.
The EAT is the leasing.
What's that?
The EAT is the leasing.
Yes.
And it is ultimately evicted.
Yeah, because remember, we transferred the ownership of the EAT to the parents. So yeah, the kids are kicking out the parents.
Well,
yeah, which brings tears. Again, another tears.
when does the EAT go back to the parent?
It has to be within the 180 days.
So this can all happen pretty quick, and you can develop a piece of property.
And we always have it, and this is a typical thing in an industrial lease, because you know it's going to be improved. We give them a lease abatement for the first year or two. say, we're gonna back end load the lease payments, but you don't have to pay any, the EAT doesn't have to pay any rent, other than token, maybe $1,000 or
So
something.
you could engineer this whole thing from beginning to end and just like be twisting your mustache, knowing that the whole thing was planned out.
No, we would never do something like
I'm a little
that.
slow, I catch
Let's do it on purpose.
That's right.
So, we have a quick question.
Yes.
So your company, are you helping come up with these ideas? Let's say, a person with a situation comes to your company, are you guys the real estate attorneys that figure all this stuff out?
Yeah, these are not new ideas. These are things that were tested across the country. But yeah, that's what we do. We structure deals.
But you're not just a 1031 exchange
Right.
specialist, you're also a real estate attorney.
Exactly. Yeah, so like I said, most of my day is spent structuring these kind of deals.
It should start with the strategy session, really,
Oh, yeah. Oh, yeah.
because you don't know what you don't know. right?
And let me just say this, a common call, and I don't want to sound promoting here, but a common call I get is from a real estate agent saying, look, I think I got something here. What can I do? We can tell them, this is how you do it. You go talk to your client, and if it works out, they come back to us. But yeah, that's what we do.
Well, I just want those that are on Zoom to separate the CE credits and not qualifying in other states from the fact that Ray's firm can be an accommodator in all
Yeah,
states.
we're all over the place.
Yeah.
I'm closing the deal this week. What's the day? Tomorrow in Hawaii. So it's
But where I see the potential is one of the first things that you said today, which was, you don't want to just be an agent, right? You want to,
this is something you got to be thinking
you want
about.
to be an investor, and this whole world opens up into something way more beyond than providing value for the client, which is important. I don't want to minimize that, but.
But it also will help you understand what the client's thinking.
Or
That's,
also help the client think differently.
yeah.
You get the credit for helping them think differently.
Yeah.
And save them money.
Go back to the first slide. I just saved you $43,000. They'd have no problem giving you a commission on that. So, okay, let's move on. The question has been brought before about partnerships and the dealing with partnerships, and these are the structure issues again we talked about. A very common structure is you have a piece of property which is owned by, we'll call it property LLC, which is owned by two members, 50-50. So this is a Jeff and Ray deal. Okay.
Cool.
When we've come in and said, okay, fine, we want to, we've made a bunch of money. We want to now sell the property, but Jeff wants to go one direction and I want to go some other direction. One problem you come into is called, say, well, how do we do that with a drop and swap? This is something I explained this. This is not the way we like to do these things. They do happen, but I want to demonstrate the principles to show you the solution. Both members want to exchange, but neither want to do it with each other. They want to go in separate directions. One wants to exchange, or maybe one wants to cash out. I just want to go take my money and run. Well, how do we do that? Commonly, what happens is we find out about this about 10 days or about 1 day before the closing. And the idea is, okay, there's no problem. What we'll do is we'll just distribute the property out to each member. So they own it 50% each. And then they'll go ahead and do the exchange. In other words, they've got my property, so Jeff can go do his swap with somebody. I can go do my swap, and we do separate exchanges. Now, that's called the drop and swap. The drop down to the members and then the swap out. The problem is you have several. How long have those members held that property, realizing they're a different taxpayer than the LLC? In other words, we've held this property for 10 years as Jeff and Ray LLC. But then a moment before closing, we dropped out on the property and Ray sells in one direction, Jeff sells another. I've held the property for a good 30 seconds, maybe 40, depending on how long the recording takes place. Have I held it for investment? No. Problem two, even though we drop it down, aren't we still acting like we're partners? And that what we're trying to do is get away from the partnership. But have we told the bank that we are no longer in partnership? Have we filed it with our tax returns or done anything? We're still acting as partners, and the IRS can say, well, if it smells like a duck and it looks like a duck, you're still a duck regarding what you call yourselves, Mr. Beck. The problem also is when you file a return, you have to list the date you acquired the property. If you're truthful, you list the day of sale. That's a no-brainer for the IRS to pick up on an audit. If you're not truthful, and you say, well, we'll put the day that the LLC got it 10 years ago, you're now susceptible to tax fraud. That's when you go to jail. You don't want to do that. These happen, and if you have enough time, like you say, we're going to sell this property in a year or two, we could do the drop right now, let us accumulate time owning the property, that works. They usually don't get that much planning ahead, and that's why there's a problem. So how do you get around this problem? Well, the way you get around it is you do is called a swap and drop, just the opposite. We start out with the exact same situation we were before, but instead of having Jeff and Ray sell the properties because it's been dropped down, we have the LLC sell it just like a normal vanilla 1031 exchange. The relinquished property goes out and money comes in. We then, what we do, we form two, once again, our friend, single member limited liability companies. One's going to be called Jeff LLC and one's going to be called Ray LLC. They are 100% owned by the historical owner, the Jeff and Ray LLC. So that's deemed the same as if the partnership, the Jeff and Ray LLC, the partner property LLC, maybe I should say it that way, acquired its replacement property. We've just did an exchange. We sold one property, bought two. We reported on our partnership tax return as basically we acquired two properties. We just own them in two separate LLCs. Note here, when we structured these, Jeff has complete control over his property. He's the manager of his LLC. He picks the property, he gets the loan, he gets the benefits of the up and down, whether it's rental income or appreciation or whatever it may be. We can allocate or structure it so that he gets that. And I can go do the same thing. Jeff wants to buy apartments. I want alfalfa fields. I'm going to go be a speculator. Hopefully it comes up. Doesn't matter what it is, but we've satisfied it because we've said it's like kind. We sold our apartments. Jeff buys apartments. I buy alfalfa field. Doesn't matter. We've held it for 2 years and so forth. Then how do we do it? After we've done that, we can, you asked the question, okay, what can we do? Well, yeah, I'm sorry, I'm behind here. This is where Jeff goes by his property. I'm going to buy my property. Again, we have that owned by the LLC. Member one is, okay, Jeff's a sole, he's member one. He's the sole manager of his LLC, gets all the benefits. I get the same for mine. Then after we have held that property for some time, those two properties, I usually like to get 2 years because we're demonstrating the property LLC is held these replacement properties. Meaning, notice here, holding that means they're filing a joint tax return. Jeff's still running his apartments and I'm still looking at my alfalfa field and I get the benefits and he gets the benefits, they're separate. After that waiting period, we then do a redemption and Jeff turns in his 50% ownership of property LLC. Ray turns in his 50% of property ownership LLC and we drop it down so that now Jeff owns Jeff LLC, which owns Jeff's property. Ray owns Ray's LLC, which owns Ray's property. We've satisfied the held for requirement. We've now separated ourselves. We really separated ourselves right at the sale of our relinquished property. We keep the structure in place to file the tax returns for a couple of years, and then we have it be separated out altogether. So many variations on these themes, but the idea is we're trying to keep the structures where they need to be to satisfy that. So let's just review quickly. Remember I said you just had to have a couple of things you need to know here. Give a deed, receive a deed. It's the exchange requirement. Only real property, no personal homes, no vacation cabins, either that kind of stuff. The first held for requirement and the second held for requirement are the same requirement. One simply applies to the relinquished property. The same requirement applies to the replacement property. All real property is like kind, with the exceptions of your personal residence and those things. You have 45 days to identify, 180 days to replace. Again, the 45 days is the most critical, is the most difficult to satisfy. This is where you see an opportunity. And I've emphasized that. Same taxpayer rule, just we need to make sure that the right people are on the deeds and gets taken care of. The accounting rules of equal or greater value and equal or greater debt, and spend all your cash. That's what you're looking for. It doesn't have to be perfect. It can be very good, even if it's not perfect in dealing with that. There's tolerance in doing that. So with that, any questions that you may have? Any things you want to talk about or struck you as we went along? Well, very good. With that, like I say, my experience has been this. I enjoy my work. I've had a very fun career. And the reason why is because clients can come to you and you can solve their problems. And there's the flexibility out there to do it. You know, it's like in the early days, think of the early surgeons, you know, the best thing they could do is use a saw. That's all they could really do. Well, now surgeons can do all sorts of things. Similarly, this has occurred with respect to 1031 exchanges. And it's like I say, there's so much flexibility to address these situations that, you know, you just got to think about it a little bit. And that's what I say, we're here. If you want to give us a call, we're more than happy to talk with you. That's what we do. We provide a lot of advice for free. So in any event. Very good.
Awesome, Ray. If there's no questions, guys, take something from your notes and use it as a talking point, right? Put it out there that what you learned about this and create a conversation starter with your friends, your families. Sydney, will you check the chat? Just do last minute.
Everyone's the same thing.
Oh, okay, cool. I just saw it blinking on there.
Is there another code, the last code, or to email in?
No.
Okay.
Yeah. But yeah, I would just say simply make sure you've sent in those codes if you would, please. Like I said, that just keeps us straight with the state. And then we'll use that information to book your CE for Utah.
Contact info back up.
Yeah, can you go back to a contact slide that has your number?
I think it's going to be back at the
Is it the
beginning.
first one?
Yeah.
Okay, just so you can pull that up again. Oh, wow. Yep. Let's see. Let's check the chat.
Someone was just asking for his contact info.
Okay. Let me I can give it over the phone or over this second here.
Yeah, we lost our screen share for some reason.
There we go.
Well, that's not shared on Zoom. Guys, send me an email if you have other questions. I'll make sure you get the contact information. Okay.
Just for right now, like I say, our Summit Exchange Services, our phone number is 801-238-4618, or you can email me at rbeck@ck, just the letter C and K, ck.law, not .com, .law. rbeck@ck.law.
And this is like the third or fourth time I've heard this, and I keep getting new takeaways from it. So reach out to me, send me an email, go back through Eventbrite if you need to contact me. Some of you found us on Facebook, so I don't have your information except for the registration page, but I did record this. It might be worth watching again and take some little nuggets from and take down some additional notes so you can help your clients. So appreciate y'all. Thanks for attending. We're going to sign off and reach out to us if there's anything we can do for you. Thanks, guys.
Thank you.
Thank you.
Thank you.